Well, holy smokes. This is not how I was expecting to start the morning. This is a complete disaster. This is exactly what puts the Federal Reserve into the pooper doopers, which is what we've been worried about. Here I am trying to set up a few different camera angles, trying to get the rest of this new computer set up so we could stream with a little less latency because it bothers me. But anyway, my goodness, this is not how we were supposed to start the day. PPI expected 0.2 comes in at 0.9. PPI X food and energy, 0.9 instead of 0.2. You might recognize for a moment what 0.9 is annualized. It's 10.8%. 10.8% annualized inflation. That is the speed at which we are flying right now. And don't pull this crap of like, oh, well, yesterday, Trump, Bessent, and Carolyn Levitt said inflation is good because it's running at 1.9% annualized. They're lying. What they're doing is they're cherry picking 6 months of data before the inflationary data started hitting us in core goods, and they're taking overall CPI inflation averaged over 6 months when we had negative inflation in March because of the tailwinds of declining prices rather than rising prices. Now we have the tailwinds of rising prices, and here they go. They show up in producer prices, and guess where they show up next? Consumer prices, to some extent. Now, fortunately, we don't expect that housing prices or rental prices are going to skyrocket again. In fact, the opposite is more likely if we end up with a big pooper doopers in the economy. Why? Well, because understand this. World interest rate probabilities right now starting to pare back. Not much, but a good chunk, a chunk enough to increase some doubt that maybe we might not even get a 25 basis point cut in September. Yesterday, you had Bessent bending the knee to Donald Trump going, you know what? We don't actually need a 25 basis point cut. We need to start with 50, and then we need to be down 125 to 150 basis points. Because, you know, inflation's only 1.9% annualized. You're smoking crack and you're lying to us. And this is why we don't trust you when you fire the head of the Bureau of Labor Statistics, because you're pissed that your numbers are bad. That's a scam. That's a fraud. That's self-dealing. It's wrong to the American people, and people don't trust you. And so then we're supposed to believe you when you say, well, I don't like that Jerome Powell is building a basement. The fucking government approved the whole project. Gosh, this is so dumb. So, of course, now they're flying off the shelf here. It keeps updating. The chance of a September rate cut dropping now from what it was, which was about 102% chance of a rate cut. The reason it's a little bit more than 100 is because they price in a little bit of a chance of a 50 basis point cut, right? That's now fallen to about 95%, 93. It's now bobbing around 96. I keep seeing it bob between 93 and 96. So we've shaved off about 6 to 7% off of the odds. So it still looks like we're going to get a 25, but this is the perfect way to set up a hawkish Powell. All Powell has to do is go, hey guys, look, I realize the employment situation really sucks. May jobs, 19,000. Dude, imagine if we're in June, it's the beginning of June, and the jobs report comes in and goes, hey guys, we had 19,000 jobs. Yeah, it's not good. June, so the release we got in July, 14,000 jobs. July, 73,000, of which 55,000 were healthcare. So the question is that going to be a labor market where Jerome Powell says, hey, you know, this is a strong labor market? Unfortunately, there's a chance he might say yes. Now, that's the crazy thing. This is where the Fed is in this ridiculous position, because the Fed might look and go, well, that could all be thanks to Donald Trump and the immigration change. Now we don't know, because Donald Trump is doing two things to screw with data. Number one, declining labor force. We don't know. When we count laborers, we don't care if they're legal or not. That's just the way it is. When the census shows up and knocks on the door, they don't say how many people in this house are legal. They say how many people are in this house. Okay? That's the point. All right? Immigration's a problem. We know that. And we don't blame Donnie T for sealing up the border. We definitely blame some of the behavior regarding deporting innocent people who only thing that they've done wrong is follow the American promise and dream of trying to come here, which politicians said if you come here and you work hard for years, you'll eventually be a legal citizen. That's the only thing they've been committed of doing wrong. But anyway, a lot of people. I know yesterday you had, gosh, who's that loser? I can't even remember who it was, but somebody from the Trump admin, most of these people are criminals. No, they're not. But anyway, so look, these PPI numbers are bad because they put the Federal Reserve in a place where Jerome Powell is going to say, look, hey, labor force is falling. Look at the unemployment rate. Even though the jobs numbers aren't great, the unemployment rate is low. Well, what is our mandate? Low unemployment rate. Okay, check. And what's the second mandate? Stable prices. Do we have stable prices right now? No. It's freaking obvious. We don't have stable prices. The only way you think we have stable prices, because we had declining prices, mind you. We had declining prices starting, and it was beautiful. Housing services coming down, core services, probably averaging somewhere around 2.2% or so. So core service is not that great because of insurance and medical and all that. And core goods, negative, right? So housing and rents coming down. We see that softness in a lot of areas, especially the overbuilt ones like Texas or Florida. You see core goods were negative. Things were getting cheaper. So if I want a hairbrush that looks like a spoon, I can get it for cheaper, okay? Anyway, so that was all happening. But now we don't have stable prices anymore. What we have is unstable prices, which the Federal Reserve has a very simple mandate. Which goal is further from target? Well, the unemployment rate's 4.2%. Yeah, we're not adding that many jobs anymore, but maybe thanks to Donnie T, that's the new normal. How do we know? We just have to follow what the unemployment rate is. That's what Powell told us last time. I bet you he's gonna hawk to us at Jackson Hole as well. That's why we have coupon code JHOLE expiring when he gives his speech, or the day he gives the speech. On the flip side, then you look at prices, and you have a complete disaster over here. So go into the producer price index for a moment, which we know all of the numbers came in ridiculously hot, annualizing out to a 10.8% result. But what's causing this? Well, we have over half attributable to margins for final demand trade services. So basically, wholesalers, shipping brokers, shipments, all the stuff related to imports, warehousing, you name it. What about this? 30% of the rise in prices can be traced to margins for machinery and equipment wholesaling. Wow. So when we raise average tariff levels from 2.2% because we don't have fair trade to 18%? Oh, wow. Machinery and equipment is getting more expensive? You don't say. The index, well, then of course we've got portfolio management. In contrast, the prices for hospital outpatient care fell. This is great. Like this is a lingering sign of the normalization right here. Is things that were supposed to go down finally are going down, like hospital stuff and insurance stuff follows that. That we were finally getting to the place of no inflation. We were finally experiencing
bullish catalyst.
Finally, we could finally get to the level of just enjoying all-time highs and listen to Sarah Eisen talk about lovemaking.
Welcome, nice to have you. So you want to talk about lovemaking, right?
She said it, okay? She said it. Anyway, so prices for final demand goods moved up 0.7% in July, the largest advance since rising 0.7% in January. 40% of the broad-based increase in July can be attributed to final demand foods. This is the non-core level, right? But mind you, core and non-core, every single level came in way above expectations. It's a complete disaster. It's very bad. And it's going to trickle up into consumer prices. This is the problem. Now, a lot of people, and I see this all the time, I hate looking at the PPI subcategories because they're so unrelatable. I mean, look at this. Categories, stage 1, 2, 3, 4 inputs. Nobody cares about this crap. But what's important is you got to ask yourself, why is the Fed probably going to be too late, first of all, okay? Well, they're probably going to be too late because the longer they keep rates high, the more likely it is we fall into an actual labor market recession. 27 weeks unemployment, record highs, the beverage curve is totally screwed up. We have extremely low vacancies and low unemployment, which is actually highly unusual. You go back 150 years, you don't get a data curve like this. And it will normalize. It's just a matter of when it normalizes. And the Fed keeping rates higher for longer just increases the chance of that normalization. So then you say, but then Kevin, if that is true, why then does the Fed not cut right now? Well, as you should. That would be the logical American thing to say. Kevin, if the labor market is so bad, why doesn't the Fed cut now? It's simple. Because of your brains. If the Fed starts cutting while the unemployment rate is low, you're not going to believe that the Fed is actually going to contain inflation. And then you will let your psychology get out of hand. You'll start going buying stuff at higher prices rather than rejecting it because you're worried about a recession. You'll be thinking, oh, 25 basis points, this is great. More margin in stocks. And asset prices will just get more expensive and you'll get more inflation. Which then you repeat what the Federal Reserve did in the 70s, which is when they lost their credibility under Burns, any credibility they had, okay? The Fed credibility is already not that high, but it's better today than it was in the 70s, let's put it that way. In the 70s, you had absolutely no Fed credibility because every time the wind blew every single month, they made a change. Oh, hike, oh, cut, oh, hike, oh, cut. It didn't mean anything. It was meaningless. So what'd you get? 4 recessions in 15 years. Think about that for a moment. 4 recessions in 15 years when the Federal Reserve didn't have credibility. What did you have over the last 15 years? You're going to call COVID a recession? COVID was like, with the exception of, because I don't want to sound insensitive, the lives that were lost, the millions of people whose lives were lost, because COVID was much more virulent when it first struck us than it is now. Now COVID's like decayed to the common cold. What a surprise. Coronavirus. What's the damn common cold? A coronavirus. It's true. Look it up. So this happens in nature, right? It decays to something that's more normal and neutral. So it was bad. It was really bad when it was first here. Millions of people died. But COVID, from a market point of view, from a money point of view, was a gift. That was not a recession. That was a joke. I remember the day clearly when on a Sunday, Jerome Powell cuts rates, emergency cuts rates. I get on the phone with my lender, hey man, sorry it's Sunday, refinance everything tomorrow. Which we did, and I dumped every damn dollar into the stock market 25 days later when my refinance is closed, which was roughly the end of March, which we all know was the bottom. It was a gift. That was a market, that's not a recession. That's not a painful, long 2, 3, 4, 5-year recession. That's not a lost decade like you could get, thanks to this AI problem that we're gonna have with the labor market. You know how hard it is to justify hiring thousands of people at a consulting firm anymore, or an accounting firm, or interns in a law firm? You know how hard that's gonna be now with AI? I'm not worried about people losing their jobs now. I'm worried about how hard it is to get people into jobs after the next recession, or during the next recession. That's when we really got the pooper dupers. So, Jerome Powell wants to maintain the psychological credibility of keeping inflation under control. This report does the opposite of what we need to encourage J. Powell to cut rates. But Kevin, well then he might have a recession. Oh well, they realize that. They would rather sustain inflation psychology now and risk a recession than lose credibility on inflation, because the recession will be way worse if you go into true stagflation. Why, Kevin? Why? Isn't it bad when people lose their jobs? Yes. And when and if the unemployment rate, I should say, when the unemployment rate skyrockets to 5.5% and then 10% soon after that, it'll happen very quickly. When that happens, it's only a matter of time. And hope you have some trailing stop losses, and I hope you get out of leveraged ETFs. Get out of leveraged ETFs, get out of anything without fundamental value, and have trailing stops, especially to cover your margin, okay? That's all I'm saying. Like, I'm not saying do that now. I'm saying when the poop actually hits the fan, don't get left holding a leveraged bag. It's one thing to hold a bag. It's a completely different thing to hold a leveraged bag. So, what happens when we finally hit the fan and the labor market rolls? J. Powell goes, cut it to 0. But by the time he does, he could cut to 0 tomorrow. Boom, like that. If he did it tomorrow, guess what would happen? Inflation expectations would skyrocket. They would destroy the future economy. They know that. That's why Powell's not cutting. So, in hindsight, will Donald Trump be right, quote unquote, and will it look like Jerome Powell should have cut? Probably. Because we'll probably go into a recession, and it will look like if only Powell cut earlier, we could have avoided the recession. But he would have been cutting earlier had it not been for your dumbass tariffs. It's no surprise that Goldman Sachs tells us 84% of tariffs are paid for not by foreigners, not by the Chinese, not by the Taiwanese, not by Thailand, by you. 84% paid by you, corporations and Americans. And it's no surprise that the minute after that, what do you get? Donald Trump, Goldman Sachs really needs some better economists. They get it wrong all the time. I'm the only economist you need. I'm Donald Trump, and I approve this message. It's dumb. Now, what's crazy, okay, you ready for this? This is the crazy part. You need to look at what's happening to this one particular security because it's really weird. But before we do, make sure you use coupon code JHOLE. Get the Meet Kevin membership. You get all 8 courses, every trade alert, because when this pooper hits the fan, I'm going to be buying so freaking much. You still get buy alerts over the next few weeks as well, of course, but there'll be a lot more when the pooper hits the fan. But you still get a lot even this month and next month. We got some stuff coming up. Every private live stream and the Alpha Report we do every single day, and you get every single course. 0 to Millionaire real estate investing. That's how I made it. Okay, not a single stock. Actually, I had Apple stock since I was in high school. But for the vast majority of my wealth came from real estate. Once you have wealth, I think it's easier to compound your wealth with stocks, once your net worth is over 5 mil or so. Psychology of money, stocks, real estate, real estate sales. You got to learn how to sell. Psychology of selling, property management, rental renovations. You get everything. It's just one price. And you get lifetime access. You pay once. Probably go back to the monthly soon. But anyway, how to make social media videos, how to get SH9T done faster, the Trumponomics. They got a big lecture release coming out for how to make the most money on the big beautiful bill. The tax savings alone, in my opinion, will more than pay for this. But anyway, check that out over at meetkevin.com and use coupon code JHOLE. But no, what you should actually be paying attention to is the 10-year. Why is the 10-year barely moving? Ask yourself this. Why would, after such a crap-ola payrolls report, PPI report, inflation report, after such a terrible report, why would the 10-year Treasury not be skyrocketing right now? Because we should be seeing lower odds of a Fed rate cut, which would mean the 10-year should be going up, not being sitting stable. This is odd. Why would that happen? Well, there's really only one reason that would happen, and that's because markets start looking and saying, all right, when we get a Fed that's squeezed into a stagflationary position, we need to balance the concern for inflation with a recession. And what happens in a recession? The 10-year plummets. I think within the next decade, the 10-year will probably be somewhere around 1.5%. We'll have negative interest rates on savings like we did in Europe in 2018, 19. But that's the future because inflation will get crushed by whatever recession we're about to head into. This is bad. And unfortunately, Donnie T's policies aggravate and prevent the Federal Reserve from actually saving us right now because of psychology. I hate to say it. That's why one of the courses you get in the Alpha, the Meet Kevin membership is stocks and the psychology of money. There's a lot into it. Only when you understand that will you understand why the Federal Reserve and why Jerome Powell are reluctant to cut. Nobody wants to hear that. They just hear, inflation's annualized 1.9%, which is a lie. Or, the labor market's weakening. Yeah. But what's the reason? Immigration or underlying weakness? We don't have the answer. Damn it!
Betrayal.
That's how I feel.
Pull up. Sync rate.
I'm sure I got more of these. But anyway, we gotta go. We gotta put together the alpha report. Come join us. Let's figure out what the trades are for today. See you there.